Welcome back to another session, guys. In this particular session, we are going to talk about money management and the psychological trading. Guys, in our previous sessions, we spoke about what is forex market. We spoke about how you can predict the market trend based upon the fundamentals analysis, and we also discussed the entry and exit point, and like how you can take your entry position or how you can exit from the market based upon the technical analysis. But this is not going to be of any use if you are not going to save your profits. And in order to help you out with your psychological biases, with your psychological factors that can impact on your decision making, we are going to have this session. And in this particular session, we are going to talk about money management, like how you can save your profits, how you can secure yourself against the potential losses, and how you can cope up with your psychological biases. So let's start with the session outline. So the idea behind today's session is we are going to talk about what is money management. Then we are going to talk about psychological trading, like how psychological factors can impact your decision making and how they can spoil your trading decisions, and you can incur the loss. So we are here to work on these psychological factors. And then we are going to talk about behavioral biases, and lastly we are going to talk about different ways to secure profits, and I will be telling you the simple rules to trade safely. There are going to be tips and tricks that you need to follow, and you can say that these tips and tricks are something related to money management. So by the end of this session, you guys will be able to trade more confidently, and I hope that you will be in a position to understand what you are doing with your trading. Like, let's suppose if you are getting encountered by the psychological biases, definitely you will be able to spot that weakness in yourself, and we will be working on how you can overcome these weaknesses. So let's talk about money management. Guys, first of all, let's speak about what we do in the forex market. This is a process. What we do is we invest in the market, we trade the market, we make profit, or maybe we make loss as well. But let's suppose we are following this process and we are making a lot of money, but it is not going to help us a lot if we are not able to manage it, because eventually if we are not managing it, or if we are trading it carelessly, there is going to be a time when we will start losing money, where we will be encountering behavioral biases, because we are not having any plan which is called money management plan. We are like, at one point of time I am trading with one lot, and at the second point of time, like in my second trade, I am trading with the 10 lots, and then again when I face loss, I start trading with the one lot, and after 10 consecutive winnings, I when I managed to recover my losses, I once again entered the 10 lots and had a losing position. So this is not what we call money management. Money management is very much important in the forex trading, because this is going to help you manage your profits, and that this is going to help you to stay in a game as long as you can. But now the question is, why we need money management, and how we can manage money, and what are the psychological factors that can impact our tradings. So guys, speaking about the psychological factors, in the forex market, we are a human being, and in term of making investment decisions, we do make mistakes, and based upon our mistake, we start encountering the emotional biases, we start encountering the cognitive heuristics. Like, this is something related to our mind, this is something related to our emotions. We have feelings, we are not we don't have artificial intelligence, but we have, our intelligence is based upon the feelings. So we do fear a lot, we do encounter greediness, we do encounter regret when we are wrong with something, or when we make losing decisions, or when we are making the decisions that we shouldn't have made. And the cognition is we try to follow the shortcuts in our trading. Like, we are not focusing on what's going on in the market. We close our eyes and we are simply going on with the flow, which is not very right. Like, we have to, every situation is unique and we have to deal it with the new idea. So the reason why we need money management is, guys, you must have observed your trading behavior if you are trading right now, and you are like, let's suppose if you have an experience of 2 months, 3 months, or 5 months in the forex market. Definitely by now you should have understand your your behavior regarding your trading. For example, this is a like in the behavioral finance, there is a theory which says that we hold our losing positions longer than our winning positions. Let me give you the example of this. This is called basically a risk, a loss aversion. And in the loss aversion thing, what we do is, like, let's suppose if you are facing a loss of $100, what you will be doing is you will be holding your position until this position comes to the profit or comes at break even before you close it. But actually what happens that market keeps on going downward, and then this loss converts into the $200. And when this happens, you are still waiting for the market to, like, you don't even want to close your losing position, and you are still holding, and as soon as market, let's suppose, reaches to $1,000, then you are regretting your decision of like holding your position, and you are saying to yourself that, okay, now I am going to close my position if market gives me a slightly bullish trend, and if like market goes to on the upper side, and if I see minus $200 loss, then surely I will close my position because this is something I can afford to lose. But market is not going to market is not liable to move as you expect, but it has its own behavior. So that is why the time will come that you will lose your whole capital. So this is what we call the loss aversion. The thing is that you are not willing to close your losing position. You are holding your losing position for the longer period of time than your winnings. Okay, now let me talk about what I am saying when I am saying like you're going to like hold your losing position, but you will close your winning position. For example, like if I am seeing the positive $50 in my profit, I will be looking to close it as soon as the market is showing some nice profit. Like, let's suppose if the profit is 100, I will close this definitely. I will never wait for, like, most of the time if I'm not like following the money management strategies, so I will never wait for market to hit my target, because I'm afraid that market will reverse back and I will lose this $100 or $50 in that response. So it means that I am waiting for I'm not closing my position until $1,000 is in loss. But I am closing my position as soon as I am seeing $100 which is floating in my in my account. This is why we need first of all this is why we need money management. And then when we are having a losing position, like let's suppose after closing $100 loss or $200 or $500 or $1,000 loss, I will be in a state of fear. Which means that I will not be able to think in a rational way, because these behavioral biases, which are the emotional biases like fear, regret, or greed, is going to dominate on my thinking, and these are not going to let me think rationally. So after a losing trade, I will start fearing, and I will not be able to enter in the market, and probably I will start missing the good opportunities. Because I'm in a state of fear, right? And as soon as I am I'm missing the winning opportunities. I knew that the gold is likely to rise above 1300, and it is likely to target 1312. But I was not able to enter in the market because I was in the state of fear, and I didn't want to have another losing position, because already I face a huge loss. So as soon as market moves, as per my analysis, I will be in the phase of regret right now. Guys, I knew that the dollar is like, let's suppose the gold is likely to go higher, and it is likely to soar above 1300 to, it is likely to target 1312, and it actually targeted the 1312. But I was not taking a position because I was in the state of fear, and as soon as market moves, I will be like in the state of regret, which means that I will be making in the state of regret in order to make myself comfortable, in order to make myself happy that it's okay, I actually didn't lose everything. Like, even though I missed an opportunity, I'm still making something. I will try to overwhelm myself with the wrong decisions, because the trade that I will be entering in order to cope up with my regret is going to be wrong. There is a huge probability, because I am not trading for the based upon the trading setup, but I am trading for this sake of trading, which means that I am trading in order to satisfy myself, in order to satisfy my ego, in order to satisfy my regret. So the chances are higher that I will not be in a state of thinking in the right way. I will not be thinking rationally, and I will make irrational decisions. I will make losing decisions once again. So yeah, this is once again is a bad thing for me, and I may like have another losing opportunity. So this is how psychological factors dominates your thinking, and you will start losing, and you will maybe you will end up losing all of your capital. So here comes the role of money management. That is why we need money management, guys. First of all, let me give you a quick definition of what is money management, but I'm afraid that this is not going to be very easy definition. Definitely, guys, we are not going to have any test, or this is just for the sake of your understanding. So money management is a process of budgeting, saving, investing, spending, or otherwise overseeing the cash usage of an individual or group. So let's talk about, like, in a simple way, money management is investing. Like, I am investing, I am budgeting, like where I need to invest. This is saving, which portion of my equity, how much percentage of my profits I will not be reinvesting in the market. So money management is all about investing, earning profit, and making trades, and making sure that how much percentage you are willing to lose, how much percentage of profit you are willing to reinvest in the market, and at what time you are going to take a withdrawal. So this is what we call money management in our sense, like in our forex market. That differentiate the amateur trader between the professional traders, because the difference is professional traders have the like very strict money management strategy, and they strictly follow their money management strategy. And even though if amateur trader have even if they have like a good money management strategy, they will never stick to it, because probably sooner or later they will get tired of it, because this is very difficult for us to stick with the money management. You will when you have a money management strategy, you will come to know that, yeah, if I have rules that I am not supposed to take more than 5 positions in a day, and I already took 5 positions, and the next position, which is looking very favorable to me, but I'm not going to take it. But this is very hard for us to keep us away from making that decision. So this is what we basically, this was the definition of money management. And in simple words, in the money management, we try to make a balance between restricting losses to acceptable limited level, which means that I am limiting myself, I'm defining my risk tolerance level. That is more appropriate phrase here. And with this, we are maximizing our potentials for profits as well. But the thing is that in case of if we are not following the money management, guys, we will be like, there will be a time when we will be risking so much that we will lose everything, or we will be like compelled to lose or stop our trading, because I am like holding my losing positions. I am trading very aggressively, like I am like successively entering 4 to 5 trades, and even though I am losing money, even though I am getting hit by the stop loss, but still I am entering in the market with new position, because I am in a state state of regret, I am in a state of fear, and I want to overwhelm myself, and I want to make some money to like in order to cover my losses. But in this way, I will be like, this is going to leave me like into the more worse scenario. So the other thing is like why we need money management is because in the absence of money management, there's a chance that you will be trading so conservatively that most of your money will stay in your pocket. It means that it will stay in your trading account. And let's suppose you are having an account of 5k or maybe 10k, and you are trading with 0.01 lot, which means that you are trading so conservatively that you will not even be able to make 1% or half of the percent, which is worthless actually, right? So we also have to make sure that we are not risking so much that, like, let's suppose I have an account of 5k and I am opening 10 lots in one position. No, this is not something that money management says. We have to follow money management. We have to make sure that we are not risking so much that if market moves against us, we lose everything, or we are compelled to close our position in a big loss. On the other hand, I am not supposed to trade so conservatively that I'm not utilizing my capital properly. Okay, so in order to cope up with these behavioral biases, we need to quantify. Like, these are some tips and tricks. Alright, let me share some tips and tricks that you should follow in order to cope up with these behavioral biases and in order to make a successful trading. The very first thing here is quantifying your risk capital. It means that I need to quantify the amount of money, or quantify the percentage that I am willing to lose in each and every trade. Let me repeat myself, guys. I need to quantify the amount of money I am willing to lose in each trade. It means that I am making a plan. Okay, even if trade goes against me, I will be losing not more than $100. And on the other hand, I will be deciding my take profit also. And most properly saying, the take profit should be like higher than your risk level. So in the beginning, I do suggest investors to go for, like, do not ever expose yourself like more than 1% of your account in the beginning of your trading when you are learning. But as soon as you start making money and you are confident about your trading, you can expose yourself up to 2% in a single trade. That will be favorable. But I have seen some traders who are exposing themselves like 50% of their equity in the single trade. Like, let's suppose they do have, they definitely are not following money management. They are trying to get rich very quick, like overnight. So they are entering, like, if they have 5k balance, they are entering like 15 lots, 20 lots in order to double their accounts overnight. So they need to understand that if market has a probability to go in their favor, market can also goes against their direction as well. So it means that they can have a losing position. So the more properly we play, the more we will have chance to stay in the market. For example, if I am risking like 1% or 2% of my account, this is going to keep me in the trading game like for the long period of time, and this will be like, I will be but the most important thing is, I will be if I know that I am going to lose $50 if I get hit by the stop loss, and if I win, I will be winning like $100, I will be like more confident about my trading. I will be okay. I will not be in a state of panic. I will not be like regretting my decisions. I will not be in the state of fear. I will be confident. Because I know whatever happens, I will not be losing more than $50. So that means that I am not let me conclude this thing, that quantify your risk level. You should, and my suggestion is during the initial years of your trading, you should never risk more than 2% of your account. And if you are aggressive, you can maximally go after 5%, but this is not highly suggested. And second thing is, guys, you need to avoid trading too aggressively. Like, let's suppose what we do here is we trade multiple times at the same day. Like, let's suppose if the price of euro is 1.18, I take a buy position. Prices fell down to 1.1790. Like, there is a only gap of 10 pips. I re-enter my position. Then I am I consistently entering the positions, which means that sooner or later I am going to expose my whole capital to the stop loss. And then we also do that, like whenever I am having a losing position, I just faced a loss, like my two, so let's suppose my two stop loss was triggered before, like right now, so I don't have to re-enter the market again, because at that particular time frame, the chances are very high that I will be exhibiting the behavioral biases. I will be in the state of fear or regret, so I will be making like non rational irrational decisions, right? Okay, in this way, this means that this shows that, like, let's suppose if I'm trading aggressively, this means that I'm not able to control my nerves. And one last thing that I have observed personally, that investors, when they are new, they do not have a trading strategy. All they do is, like, they are like, when they start losing money, why they trade aggressively? First of all, they are losing money. First of all, that's why they are trading aggressively, or you can say they are trading aggressively, that's why they lose money. So both things are same. But the thing is that as soon as they are in loss, they will start entering on the bullish or bearish momentum. For example, on the 5 minutes chart, if the candle is green, I will enter a buy position without seeing what the actual trend is. I am overlooking everything. Why? Because I am not in a position to understand what I am doing. So the best scenario, the best thing you can do is just shut down your system. If you have consecutive losses, just simply shut down your system, go outside, maybe go to your friends, maybe take some time for you, and come again with the fresh mind. And whatever you lost is okay, because if you are following the risk man, if you have decided your risk tolerance level, which is like, let's suppose 2% in case but like 2% in case you hit the stop loss, so which means that you are not that down, right? You are not, you are okay, your trading is okay, your balance is okay, you still have an opportunity to start trading, and in this way you can recover your loss and you can go on towards profitable path. Try to avoid, I will conclude it here, try to avoid trading too aggressively. And then you have to be realistic with your expectations. The reason why most of investors, like 95% of investors, lose money in the market is because they are not very mature from their mind. They are here to get rich quick, guys. First of all, like, if you are, even if this is not going to sound very good, but this market is not about to get rich quick. This is not going to make you billionaire overnight, because this is just like any other business. Forex trading is also a business. You have to wait for the right time to take the right opportunity, and this right opportunity is not likely to give you billions of dollars. Like, it definitely depends upon the amount of capital you have invested. But the thing is that your goals need to be realistic. I can't think of making like 1,000% return after opening the 1K account. So definitely I have to decide, like, I should have a realistic goals, maybe 50%, if 100% on the yearly basis, or maybe 10% or 15% on the monthly basis, or maybe depending upon the trading strategy, 5% on the monthly basis. That is something we can expect from the market. But we can't do like I got $1,000 account, and that in the week or so I needed to make $10,000 or $50,000, which is not a very realistic goal, because in this way you are going to use high amount of trading volume, and high amount of trading volume is going to expose you towards flattening your account. So simply like, look for consistent return. Maybe you decide to earn like 7%, 10%, 50%, 20%, or maybe 35% return on the monthly basis, and you have to stick with it. You have to, like, follow your strategy consistently, set up your take profit, and that's pretty much it. Like, you have to whatever you decide, this should be realistic. Guys, first of all, let me tell you what is drawdown, and then I will link it with our next slide. The drawdown is what I am losing. Let's suppose you got $1,000 and you are losing 50K in from it. So what is the percentage of your loss? You are losing like 50% of your amount, which is a drawdown. But it means that you are risking 50% of your capital, right? But let's suppose, okay, I'm keeping this in this way. Like the only thing I'm going to do is I'm going to limit my the percentage of my drawdown, and I'm expecting that I am 30% successful, 70% successful, or 30% unsuccessful. Alright, if you think this is difficult, then let's do this. I am 50% successful and 50% unsuccessful. Even though I have to decide my risk and reward ratio. If my risk and reward ratio is like, let's suppose 3:1, 3 for reward and 1 for risk, or you can say that let's do this in this way. Like I am risking $1, 1:2, or 1:1. It means that for every $1 reward I am risking $1, which is not that much acceptable, but let's say we have to deal with it. So second best scenario is our risk and reward ratio should be like 1:2. It means that one is risk and this one is reward. And on the other hand, in that case, this is reward and this is risk. So our risk and reward ratio, let's suppose guys, our risk and reward ratio is 3:1, which means that it's let's say it's a reward to risk ratio, which means 3 is a reward and 1 is a risk. And if I am not that much mature trader, and I'm just having a 50% success ratio with my trades, you can see here, even though I will be in a position if my risk and reward ratio is accurately defined, my risk to reward ratio is 1:3, which means that I am risking $1,000 and I am winning $3,000. And after 10 trades, 5 are losing and 5 are winnings. So even after being only 50% successful in the forex market, if we take a sum, I lost $5,000 and but I won $15,000. And if I minus 5,000 from 15,000, it means that I still made 10K out of 10 trades. So isn't it like very exciting to see? Like the only thing we need to do is we need to define our risk and reward ratio. Even though if you are following the 2:1 risk and reward, you still be making like 5,000 return in this particular scenario, only if you are successful 50% of the time. Guys, the person with no skills has a 50% probability of getting a profit and 50% probability of getting a loss. But when like I'm sure that after this the course on demand, like after all these sessions, you will be able to make like 80% or up to like 80 to 85% profitable decisions right now. Guys, there is never 100% success in the market. You have to lose money in order to take a correct position, because if I entered a buy position in euro US dollar, the trend was trend just reversed, I have to close my position in loss in order to take a new trend. Like if I never ever can write the new trend until my old position is open, which was on the other direction. Alright, so guys, that's the end of today's session, and I hope that you enjoyed this session, and I wish you good luck for your trading. And I really hope that after all these fundamentals and technicals and psychological trading videos, you guys will be able to make some nice profits in the forex market. And if you guys have any question, you can just email us and we will be there to help you out. And lastly guys, don't forget to share your feedback with us, and thank you so much for joining us. See you next time.